REIT property sectors that have been trading below NAV for some time now could get some, potential glimmers of hope because theoretically, maybe that M&A option is out there. I think you would need to see maybe some larger cap REITs that have been trading at discounts for quite a while be privatized or be acquired by another REIT and maybe see the momentum trickle over into real price movements for the rest of the REIT sector. But it is an encouraging sign.
Hello, welcome to the REIT Report. I'm your host, Sarah Borson-Keto. It's been an active time lately for REIT M&A, with transactions being announced in the timberland, industrial, and hotel sectors. To bring us up to date with the latest REIT M&A developments and what it could mean going forward is my guest, Danny Ismail, co-head of strategic research at Green Street. Danny, great to speak with you again.
Of course. Thanks for having me, Sarah.
So, Danny, could you maybe start by putting recent news into context by describing what we've seen when it comes to REIT M&A activity over the past few years?
Sure. So REIT M&A activity has been robust recently, but we should put it in context. So if I use the pandemic as a starting point, 20 through 22 were quite busy from a REIT M&A perspective, with a good mix of public to publics as well as privatizations. So over $300 billion worth of deals were done in that pandemic era time. And the backdrop was generally pretty conducive to deals. So REITs were trading generally below private market values, and we were still in a zero interest rate environment. So a backdrop that is generally pretty conducive for M&A. That all changed when interest rates began rising throughout 2022. So the next 2 years, 23 and 24, saw some big M&A deals in REIT land cross the finish line, but generally with less activity as well as smaller check sizes. We at Green Street believe that commercial property prices peaked in 22 and then bottomed in late 23. And so there was a bit of a lull in REIT M&A as participants really wanted to see where the dust would settle in terms of property prices post interest rate rise. If we come back to the present, 2025, REIT M&A has been active, but with materially smaller check sizes compared to the last decade, about 80% smaller than over the past 10 years. European M&A, just to briefly touch on that, is also seeing a similar trend in REITs with a very active REIT M&A scene in Europe, but with also similarly smaller check sizes. So it's been a pretty busy year for REIT M&A. It's been keeping the bankers and lawyers busy and us busy here on the research side. And it looks like it could very well continue into 2026, particularly if or when interest rates decline.
We've had this activity lately that includes Rainier and PotlatchDeltic, Plymouth Industrial REIT, Sotherly Hotels, as well as news of other REITs examining strategic options. Can you talk a little bit more about why we're seeing that and what it could signify for momentum in REIT M&A going forward?
So I think there are a few things to take away from recent REIT M&A. With the first is that people and investors generally feel confident underwriting and owning commercial real estate at today's prices. Total transaction volume in U.S. commercial real estate has been recovering in 2025, and you can generally be more confident at where cap rates are in most sectors relative to the past 2 years, given that increase in activity and clarity in terms of where private market pricing is. The second is that clearly capital wants to be put back to work in real estate. The debt markets are wide open in commercial real estate. Credit spreads are historically tight, and that's generally conducive to getting deals done. The equity side is less open, particularly for certain sectors and for more core-like real estate, but that's been slowly thawing as well. Lastly, as you mentioned, from a seller perspective, there are some compelling reasons to sell today. REITs have been trading below NAV for a few years now, particularly in certain sectors like the traditional REIT sectors like apartments and office, which have been trading at deep discounts for a few years. Selling helps close that NAV gap and delivers tangible value back to REIT shareholders. And so for many smaller cap REITs in these unloved property sectors, that may be the most optimal route for management.
As you've reviewed these latest M&A announcements, does anything strike you as particularly notable?
So I think a few things. As you mentioned, the diversity of sectors is interesting. We've seen lodging, industrial, timber. Earlier this year, we had office and apartments. Late last year, we had strip centers. So there's a real diversity of property sectors that have been either acquired or merged with another REIT. The second are the premiums paid. So in a typical REIT M&A event, there is typically around a 15% premium to unaffected share price paid. And some of the most recent proposed deals were well above that. So you mentioned Plymouth. That was done at a 50% premium to unaffected share price. Sotherly was 150% above. So 15% compared to 50 and 150% is a pretty big delta compared to history. One silver lining of these smaller checks that we're seeing written in REIT M&A is that If you combine a smaller check with some leverage, you can get some pretty big premiums to unaffected share prices, at least one positive from the smaller check sizes. The last thing I would mention is that the most recent bout of privatizations that we've seen in REIT M&A has not been from the usual private equity crowd. So when you think about REIT M&A, it's generally Blackstone and Brookfield that come to mind as the usual acquirers of REITs. And this year, you've seen a pretty diverse pool of buyers as well as buyer type.
Why do you think that could be happening?
I think for a few reasons. So I think you have different buyer types in the form of the growth of private credits, as well as viewing certain forms of commercial real estate as an outgrowth of private credits. You've been seeing that particularly in more longer duration net lease sectors, where you've seen an interest in gaining private credit-like attributes, and certain real estate sectors fit there. The second is I think you have these generally discounted property sectors and discounted smaller cap REITs that are conducive for smaller or more mid-sized private equity firms to acquire. But as I mentioned, a smaller check size, right? So theoretically, it opens up the door for a more diverse buyer pool. And then lastly, I think there is a certain amount of capital that was raised for distressed opportunities or value add opportunities in commercial real estate that might be making its way to the public market. That being the sense of a lot of transactions in the private markets whereby values may have fallen below where sellers are comfortable. You could have in the public markets more conducive sellers because they've seen REIT share prices at those levels for quite some time.
And Danny, you've mentioned these quite exaggerated premiums to REIT share prices. Do you think we could possibly see REIT share prices looking ahead really better reflecting the fundamentals?
One would hope. It would be great to see that. Generally, what we have seen, though, and this is a broad generalization, is that a lot of the deals that we've been seeing have been so idiosyncratic in the situation or the property sector that we haven't seen material spillover effects into broader REITs. So, for example, a lodging privatization or an industrial privatization, not necessarily even done at large premiums, not necessarily affecting the rest of the sector in terms of seeing those share prices of other REITs move higher. I think it's a good mark. It's a good indication of interest. But generally, because of the smaller check sizes that are being written, and then two, usually some of the idiosyncratic things happening with the REITs, whether are they over leveraged? Were they misallocating capital? Do they have subpar governance? Something like that. Private capital might have needed to enhance or fix, not necessarily translating to some of the larger cap REITs that you see out there in the space. I do think it is good to see that momentum and good to see private capital helping to close the NAV gap. That is supportive of higher share prices, but I think it's part of the overall mosaic that should hopefully support REIT share prices in the future rather than a supporting pillar.
Danny, finally, any other thoughts on what we could expect to see from REIT M&A activity? Any other sectors you think might be particularly active or anything else on the radar?
It's interesting in the sense that you have traditional REIT property sectors that have historically garnered the most transaction activity as well as some of the most fundraising, this being, say, apartments is a good example of that, where you've seen some deep discounts for a few years now. The office sector has been trading at deep discounts for several years, and we've now seen 2 privatizations in that space. So there are some encouraging signs that REIT property sectors that have been trading below NAV for some time now could get some potential glimmers of hope because theoretically, maybe that M&A option is out there. I think you would need to see maybe some larger cap REITs that have been trading at discounts for quite a while be privatized or be acquired by another REIT and maybe see the momentum trickle over into real price movements for the rest of the REIT sector. But it is an encouraging sign that it's always better to see more deals done than fewer. Some optimism heading into the new year.
Danny, thanks so much for your time today.
Of course. Thank you, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.